Assalamualaikum warahmatullahi wabarakatuh. This analysis is for financial management subject FIN 420, case study, financial ratio and analysis. Our group chose in the transportation and logistics sector. Our group member is Ahmad Shahrizal bin Mukhtar, choosing Post Malaysia Berhad Company. Aziz Zafran bin Azlan, choosing company MMC Corporation Berhad. Muhammad Hazlan Zakaria, choosing company Surya Capital Holding Berhad, and Nurzairi bin Ahmad Hashim, choosing a Tasco Berhad company. Okay, the background of the company. The first one is Post Malaysia Berhad. Post Malaysia Berhad is a postal delivery service in Malaysia with history dating back to early 1800. Post Malaysia is a company that specializes in postal and associated services such as receiving and dispatching mail, providing postal financial services, trading in philatelic items, and selling stamp. Mail, courier, and the retail are the three segments in which the company works. For MMC Corporation Berhad. MMC Corporation Berhad is a Malaysian utility and infrastructure conglomerate with diversified businesses under three divisions: energy and utilities, ports and logistics, and engineering. MMC's key businesses in its ports and logistics division. MMC Ports is currently one of the 10 largest port operators in the world. MMC Ports included the ports of Tanjung Pelepas, Johor Port, Penang Port, North Port, and Tanjung Beruas Port.
Incorporated in 1983, Surya Capital Holdings Berhad, or as known as Surya, has risen steadily into a diverse entity. Surya Capital Holdings Berhad is an investment holding and property development company. The company, through its subsidiaries, provides, maintains, regulates, and controls port service and facilities. Tasco Berhad was incorporated in Malaysia under the Act on 10 September 1974 as a private limited company under the name of Trans-Asia Shipping Corporation Sdn Bhd. Effective from 10 September 2009, name has officially changed to Tasco Berhad. Tasco Berhad is principally engaged as a total logistic solution, provided while its subsidiary companies are principally involved in the business of truck rental, in-house truck repair and maintenance, insurance agency service, and warehouse rental, as well as provider of service related to freight forwarding.
Financial ratios are made with the use of numerical values selected from financial statements to gain important information about the firm. The numbers obtained on a company's financial statements, income statement, balance sheet, and cash flow statement are then utilized to perform quantitative evaluation and assess the company's liquidity, growth, leverage, profitability margins, rates of return, valuation, and others related. Ratios compare points for businesses. They calculate stocks within an industry. Also, they measure a company today against its past numbers and financial history. Nearly all cases, it is also essential to know the variety driving ratios, as management has the flexibility to, at times, modify its strategy to create its stock and company ratios more appealing. Commonly, ratios are typically not used in separation but rather in mixture with other ratios, giving a good idea of the ratios in each of our presentation mentioned when give a complete view of the corporation from different direction and help you notice possible Red flags. Under financial ratios, we have five main ratios: liquidity ratios, leverage ratios, activity ratios, profitability ratios, and market ratios. Liquidity ratios is a very critical part of business. Liquidity is required for a business to meet short-term obligations. Liquidity ratios are a measure of the ability of a company to pay off its short-term liabilities. Liquidity ratios determine how quickly a company can convert the assets and use them for meeting the dues that arise. The higher the ratio, the easier is the ability to clear the debts and avoid defaulting on payments. This is a very important criteria that creditors check before offering short-term loans to the business. An organization which is unable to clear dues results in creating impact on the creditworthiness and also affect credit rating of the company. Under liquidity ratios, we have the current ratio. The current ratio evaluates a firm's capability to pay short-term commitments or those due within 1 year. It informs investors and analysts how a firm can extend the current asset on its balance sheet to satisfy its current debt and other payables. A current ratio that is consistent with the industry average or slightly higher is generally considered adequate. A current ratio that is lesser than the industry average may show a higher risk of default or distress. Also, if a company has a very high current ratio compared to its peer group, it indicates that management may not be using its asset effectively. The current ratio is known as current because, unlike some others liquidity ratios, it includes all current ratios, current assets, and current liabilities. The current ratio is sometimes described as the working capital ratio. In this graph, we can measure which company could pay certain obligation on time. MMC have the lowest current ratio compared to the others company in 3 years, and this indicate that they don't have enough current asset to pay its short-term obligation on time compared to the industry average. Even though posts are slightly higher than MMC in term of ratio, but still they are lower than average ratio 1.5. Surya have the drastically increased from 2018 to 2020 from having the most liquidity asset. It shows that this company have a problem having problem with not utilize the current asset efficiently. In other words, they are playing the safe game, having lower profit and low risk of losing assets. Another company which maintaining ratio higher than 1.0 in 3 years and having stabilized stable and managing its current asset very good is Tasco. Here we can view in 2018 the ratio is 1.74 while in 2019 decreased to 1.43 but still inadequate and utilizes its current asset very well even though lower than 1.5. That means this company utilizes its current asset in good term. While in 2020 it increased to 2.1, higher than most previous years. Quick ratio. Quick ratio is one of the liquidity ratios used to determine the company's liquidity position, project investment, or profit. The unique characteristic of this ratio from the other liquidity ratio is that the ratio is only using cash and cash equivalent items for calculation and analysis. It ignores other items which may not quickly convert into cash easily from the calculation. For instance, inventories are not included within the calculation because they are taking much longer to convert into cash. This ratio is sometimes labeled as a cash ratio, yet the value is still dissimilar. The ratio is greater than 1. The entity's current assets following the deduction of inventories are higher than current liabilities. This means the firm could utilize its current asset to pay off current liabilities. In other words, that the entity is financially sound based on this ratio. If the ratio is lower than 1, the firm might not pay off its current liabilities by utilize its current asset. That indicate that the entity is not financially strong. From this chart, we can know which company have the better ability to pay its short-term obligation and which company have less ability to pay its short-term obligation on time. For both companies, they have started a good ratio in 2018 with 1.17, but after that they completely decreased statistically to 0.84 times in 2019 and 2020 0.81 times. This reflects the fact that this company having problems paying their short-term commitment without relying on inventories or prepaid expenses. Meanwhile, MMC firm is having the lower ratio in 2018 with 0.82 times, and this continues after 2019 0.73 times, and in 2020 they increased the ratio to 1.06 above the average. Even with the increase, MMC should start placing more of their net earnings into cash equivalents, and marketable securities. They can also lessen their liabilities by reducing expenses and pay off debt. Surya and Tasco have the highest ratio in 3 years term. With average ratio more than 1.0, this indicates both companies utilize their current assets rather than depend on inventories for paying their debt on time. But too high ratio indicates that company not using its cash asset to work. This will cost them such a waste in terms of company profits. For Surya, in 2020, this company have ratio more than 3.35. In order to maintain less than 3 and gain more revenue, it is desirable to invest more extra big assets into development that will produce and make business expand or make it more effectively.
Leverage ratio. A leverage ratio is any one of several financial measurements that look at how much capital comes in the form of debts or loan. The ability of the company to meet its financial obligation. The leverage ratio category is important because company rely on the mixture of the equity and debts to finance their operations. And knowing the amount of debt held by a company is useful in evaluating whether it can pay off its debt as they come due. The three main financial leverage ratio are debt ratio, debt to equity ratio, and time interest earn ratio. In this analysis, we'll present a debt ratio and time interest earn. Debt ratio. The debt ratio is a financial ratio that measures the extent of the company's leverage. The debt ratio is defined as the ratio of the total debt to total asset, expressed as decimal or percentage. It can be interpreted as the proportion of the company's assets that are financed by debt. A ratio greater than 100% shows that considerable portion of debt is funded by asset. In other words, the company has more liability than asset. A higher ratio also indicates that company may putting itself at risk of default on its loan if interest rate were to rise suddenly. A ratio below 100% translates to the fact that greater portion of the company's asset is funded by equity. Formula for debt ratio: total debt or liability divided by total asset. In this analysis, Surya Group shows the lowest percentage for each year from 2018 to 2020, which is 23.9% in 2018, 19.12% in 2019, and 19.57% in 2020. This shows that Surya Group is in a strong financial situation compared to Post Malaysia, MMC Corporation, and Tasco Berhad. For these three companies, all debt ratio exceed 40% for each year in this analysis. Okay, time interest earned. Time interest earned, or TIE ratio, shows how many times the annual interest expense are covered by the net operation income, or income before interest and tax, or the other name is EBIT of the company. It is a long-term solvency ratio that measures the ability of the company to pay its interest charge as they become due. Time interest earned ratio is known by various names such as debt service ratio, fixed charge cover ratio, interest cover ratio. Then the ratio is expressed in times. Formula for the time interest earned is EBIT, or income before interest and tax, divided by interest. In this analysis shows once again, Surya Group is the higher company for the value of time interest earned ratio, which is 26.3 times in 2018, 20.5 times in 2019, and jumped to 55.6 times in 2020. For Post Malaysia in 2019 and 2020, the company suffers severe losses and impacted the times interest earned during the year. Other than that, Tasco Berhad showed the decrease from 6.57 times in 2018 to 2.15 times in 2019 and 2.08 in 2020. For MMC Corporation, interest earned times showed the decline in 2019 and up again in 2020.
The third ratio that we will discuss is activity ratio. There are 5 types of ratio under activity ratio, which is average collection period, accounts receivable turnover, inventory turnover, fixed asset turnover, and total assets turnover. However, we will discuss only 2 types of activity ratio, that is average collection period and total assets turnover. The purpose of activity ratio is to indicate how efficient the manager used the available resources in order to generate sales and its contribution towards the achievement of the firm's goal. First, we will discuss about average collection period. Average collection period are to determine the average length of time taken by the firm to collect its debt from the credit sales. The formula of average collection period is account receivable divided by daily sales. In this chart, the best average collection period in 2018 is company Surya Capital, where the average collection period is 43 days. This shows Surya Capital are better in their debt collection in 2018 compared to the other companies. In 2019, the best average collection period is Tasco, where the average collection period is 55 days. Tasco might have less problem in collecting debt in 2019 as compared to the other companies. In 2020, MMC Corp have the best average collection period, where the average collection period is 54 days, the best among average collection period in 3 years between the 4 companies. MMC Corp have less problem in collecting their debt and better in their debt collection compared to the others. Next is total assets turnover. Total asset turnover are used as a measure of a firm's ability to manage all of its resources, invest to generate sales. The formula of total asset turnover is sales divided by total assets. In 2018, Tasco have the highest total assets turnover, which is 0.95 times, while MMC Corp have the lowest total asset turnover, which is 0.13 times. However, MMC Corp have the highest total asset turnover, which is 1.15 times in 2019. The lowest total asset turnover is Surya Capital, that is 0.2 times. But in 2020, MMC Corp turned to have the lowest total asset turnover, where the total asset turnover is 0.09 times and the highest total asset turnover is 0.79 times that belong to Tasco. The next ratio is profitability ratio. Profitability ratio have 6 types of ratio: gross profit margin, operating profit margin, operating ratio, net profit margin, return on equity, and return on asset. The purpose of profitability ratio is to measure the relative success of the company. This measure is combination of effect of liquidity, activity, and leverage management of the company overall operating result. The first ratio that we will discuss under profitability ratio is net profit margin. Net profit margin formula is net profit divided by sales. Net profit margin first is to measure the after-tax profit per ringgit of sales. In this chart, Surya Capital have the best net profit margin in 2018, that is 13.21%. This shows that Surya Capital are able to generate higher profit income to shareholders compared to other companies in 2018. Again, Surya Capital have the best net profit margin in 2019, where the net profit margin is 18.96%. In 2020, the highest net profit margin is MMC Corp, which is 18.3%. As we can see in this chart, Pos Malaysia have the lowest net profit margin 2 years in a row. That is in 2009 and 2020, where the net profit margin is negative 14 and negative 15%. This happened due to Pos Malaysia have lost profit in these 2 years.
Alright, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Okay, on my side, I will be presenting return on assets, or what we call ROA. So, ROA measure the management's total efficiency in creating profits using its available assets. As you can see in the graph, we use the formula for ROA, which is earning after tax, we divide it by total assets. Therefore, we will get the total. So, as we can see in the graph too, Tasco has a stronger momentum of 3.93% for 2018, indicating that it has a greater return on assets invested. But sadly for MMC Corp, it has the lowest return assets at 1.04%. Next, in 2019, Surya took up the top spot with a higher return assets of 3.79%, while Post Malaysia remains at the bottom with a return on assets of negative 6.44%. Next, in 2020, Surya remains at the top, accounting for 2.36% of the highest return on assets for the year, while Post Malaysia, on the other hand, remains at the year's low of negative 9.7%. Okay, next, dividend payout ratio. Before we proceed to dividend payout ratio, I will explain a little bit regarding the market ratio first. Okay, market ratios are critically for publicly listed companies since they are utilized in the stock valuation process when selecting securities for investment portfolios. Therefore, the market price of the firm's share reflects the outcome of its activities. 6 main target ratios, which we would know as EPS, earning per share, dividend per share, which is DPS as we know. Then second is dividend payout ratio, which I will be going to present after this. Dividend yield, next book value per share, and last but not least, price earning ratio, or what we call as PE ratio, which I will also be presenting about it. Okay. dividend payout ratio. As we can see, the dividend payout ratio reflects the amount of current profits available to common stockholders that is paid out as a dividend. The formula we use for this particular point is dividends per share divided by earning per share. So therefore we will get the answer for each particular year for 2000 until 2018. Okay, as we can see in the bar, for 2018, MMC Corp has the greatest dividend payout ratio of 0.55 per share in 2018, indicating that it has the most earnings, while Post Malaysia has the lowest dividend payout ratio of 0.12%, indicating that it has the lowest earning of the year, as we can see in the graph. Next, we move to the 2019. MMC Corp still remain the best dividend payment ratio of 0.5%. 0.5 per share in 2019. A little differ from the previous year, where Post Malaysia also shows a significant decline of 0.01 per share. In 2020, the bar shows that Tesco increased their dividend payment ratio from 0.38 per share last year to 0.5% per share in 2020, taking to the top place of the year, and Post Malaysia had yearly low of 0.0016 per share this year, that year, particular year. Okay. Next, I will be explaining regarding our analysis and find out of the 4 companies for price earning ratio. Okay. Before we proceed, I explain a little bit. Okay. As we know, price earning ratio illustrates the link between the company's share price, which is, we know, the common stock, and its earning per share. Also, not forget to mention, it also reflects the investors' preference for the company's share in relation to the available profits, which the amount of money investors are ready to pay for each dollar of profit created. Okay. So the formula, as we know, market price per share divided by earning per share. Market price per share versus EPS, what we know as earning per share. Okay, referring to the bar, we can conclude that in 2018, MMC Corp price earning ratio is 0.53 times, which is the firm made the most profit than the Post Malaysia and Tesco, which have an average of 0.14 and also 0.11 times respectively. When compared to others, Surya, on the other hand, had nearly reached a zero-digit price earning ratio of 0.10. Proceed to the next year of 2019. MMC Corp bar has decreased somewhat, but remains at the top of the list with 0.36 times, while Post Malaysia, as we know, has exceeded the deficit of negative 0.054 times, which is the lowest. In 2020, Surya and Tesco commonly have rarely share the same price earning ratio for the year of 0.11 times, the average of the year. But we can conclude that Post Malaysia shows some improvement, slight improvement price earning ratio compared to the last year, from 0.054 times to negative 0.03 times. And MMC Corp once again overtakes the best price earning ratio, but still decreasing for the year 2020 of 0.25 compared to the last year. Alright, that's all for me. Thank you for listening.